All right, good afternoon, everyone. My name is Gordon Sattro. I'm the Managing Director of Nationwide Mergers and Acquisitions for Greenlight Business Group. Greenlight Business Group is the largest cannabis business brokerage in the United States. We operate from the state of Maine all the way over here to California. We have taken a front row seat to many receiverships. A couple you might be aware of would be High Times and State House. So we're the ones that are helping to liquidate these assets. And just want to say, receivership is a new R word in California behind regulation, but it is not something that we need to be afraid of. It's something that is a tool and can be considered a good thing.
Great. So once assets are starting to stabilize, Gordon, I know your brokerage sells many of the distressed assets. From your vantage point, what's driving the wave of receiverships that we're seeing, and what does it signal about the California market?
Yeah, so as far as drivers, I would say that there are three forces that are driving receiverships. It's law, math, and momentum. Obviously, Kieran talked about the law. Federally, you can't use Chapter 11 as a protection, so you're going into receiverships. So as these businesses face cash flow issues, face difficulties, the only option that they have is receivership. So that's why we're seeing the uptick because of the law. More importantly is the math. What are we dealing with? We're dealing with price compression across the market. We're dealing with taxes here in California and 280E. It's kind of hard to run a business when 30 to 40% of your margin is being directed toward taxes. And then finally, we're dealing with the illicit market as well. How can we compete when we're being fully compliant, paying all of our taxes, and then someone down the street isn't paying taxes, is not concerned with compliance, and they can sell a cheaper product because they have huge margins? That's the math side of it. And then finally, momentum. And I've seen this across the United States. A lot of people, they took out high interest loans and they tried to grow way too quickly. And a lot of these people thought the price per pound of cannabis would never go down to X amount. A lot of people thought that the legislators would not allow for additional licenses in the market, and before they know it, they might have been the one cultivator within a municipality or one of two retail shops within a given area, and then all of a sudden they're in a highly saturated market. So that's why we're seeing these receiverships come up. And then what does that trend tell us? What are we seeing on our end? Prices are going back to fundamentals. It's compliance, cash flow, location. If you have those things, we're going to be able to sell your business at a good price. If your business is going into receivership, but having some cash flow issues or some high interest loan that's coming to bear, which in 2026, $2 to $3 billion in loans are going to be coming due. So Kieran's going to be a lot more busy, and I'm going to be a lot more busy as well. But it's going to be coming down to basics, and it's going to be some consolidation that we're going to be seeing, and a lighter way of putting it is that we're going to have a leaner California market. But what I would say is that with receivership, we shouldn't view it as a negative thing. We should view it as a bridge. It's a bridge to a better market for better operators, and where these assets can be redistributed to people that actually know how to operate properly. Because you cannot go and over leverage yourself and expect it to bear out at the end.
How do you find those people that know how to operate it properly?
Oh, yeah. So, with the buyers, so when we were selling High Times, we received, I believe it was 37 offers. With State House, we received over 73 offers. So people, when they're coming in, they're looking at an opportunity in receivership. They want to break up the asset. Our job is to put all the pieces together to make sure it is fully liquidated in the end. But they're being held over a barrel here. They don't really have that flexibility, so they might be selling parcels of land that are associated with this whole portfolio for pennies on the dollar. And it is a good opportunity for a buyer here, because at the end of receivership, that business is free and clear of any liabilities. It's free and clear of any of the compliance issues. So in the end, if you're a buyer and you have a capital, acquiring the assets via receivership is a good buy, as long as it's at a good location. Those weaker locations, though, I don't really see them surviving even via receivership. They'll get it for pennies on the dollar, and they'll reposition or reorient that commercial property to something else.
Thanks. So Gordon, as assets change hands, like, are you seeing any patterns in pricing or capital access that you think is really going to shape the market in the future?
Yeah, so with regard to pricing, what we're seeing is kind of a barbelling of prices right now. What do I mean by that? So a barbell is a bar that you put weights on either side, right? So on the far left, imagine that we have businesses that are non-compliant, cash flow issues in a bad location. Those businesses, when they go into receivership, they're going for rock bottom prices, highly discounted, not retaining much of any value in any of those creditors. As Dana said, they're not going to be getting anything out of it. You cannot squeeze that hard enough to extract good value. In the alternative, there are some really great opportunities that are going into receivership on the other end of that barbell that retain a lot of value, where they might just have over-leveraged themselves to the hilt, but the fundamentals are strong. They were fully compliant before, they still have a good customer base, and they can be cash flow positive once they dump those liabilities. So the pricing there is still going to be strong after the fact. And that even applies to the general market too. As far as capital goes, I remember I was at Benzinga in Miami in 2023, and we announced the capital markets were dead. That's not true anymore. Right now, capital is still there, but it's strategic. It's looking for that exact right opportunity. And extracting value out of these receiverships is one of the things that they're doing. We saw State House, that got liquidated, High Times, liquidated, Gold Flora, right now in Santa Monica, October 23rd. They're gonna be liquidating at that point. So there are people extracting value and buying these opportunities for a reason, but it's about having the strong fundamentals. And what does this tell us about 2026 in California? I'll tell you. We're gonna have a leaner market. There will be mass consolidation. Those businesses that are operating on the fringes, that are having the cash flow issues, that are in bad locations, they will not be acquired and replaced, they will be gone. And that is what's needed. I would love for every operator to have $1 million in EBITDA, annualized, and be fully compliant and running a great business, but that's not how business works. And the fundamentals operate in the business world as much as they operate here in the cannabis space. And we're getting back to fundamentals. And there will be consolidation, but those operators that are still on board running those strong businesses will be able to sell at top dollar. Right now, if someone had a business with $1 million in EBITDA, I have 4 buyers that would enter into an LOI tomorrow for California. There are people coming back into the state with new money, but it has to be the right opportunity. And it's making sure that you have those fundamentals that are strong. Or if you fall victim to some sort of mistake and you wind up in receivership, make sure that the fundamentals are strong beyond whatever you did to get yourself there. And we can extract that value for you.
We do hear some optimism in your voice there, so that's good. As we wrap up, I would love if we just go down the line and tell me something that gives you the most confidence about the next chapter in California's cannabis market.
Yeah, receiverships. Like I said, it's a bridge to a leaner California with better businesses, better operators, and better locations. And once those efficiencies come into place and we get the best operators there, prices will be more competitive with illicit businesses. And the goal should be to get rid of illicit operations. And when the operations on the legal side and the compliance side get efficient and get better, it will not be profitable to run an illicit business. In the same way, we don't see too many moonshiners here in California. You can go to a liquor store. So consolidation can be a good thing. Efficiency can be a good thing. And receiverships are very much a bridge to that.
Well, thanks to all my panelists. You guys really are experts in the space. So nice to be up here with you guys.
Thank you, everyone.